Are you someone who wants to invest in an IPO but are not sure about all these terms? Whether you are an aspiring investor, a budding entrepreneur, or just a stock market newbie, knowing these terms can help you make more informed investment decisions. Moreover, it also helps you analyze company performance post-IPO, interpret financial news accurately, and navigate through potential risks. But what are these terms? We'll get into it, but before that, make sure you subscribe to the Moneycontrol channel. Well, the first term is IPO itself. So IPO or initial public offering is the first sale of shares by a company to the public. In this, a privately held company becomes a publicly traded company by offering its shares to the public and getting listed on the stock exchanges. This offer of shares allows company to gather capital and on the other hand provides an opportunity for the public to invest and become the shareholders of the company. Now, when a company decides to launch an IPO, they have to go through a defined process. Here comes the term DRHP and RHP. A DRHP, that is a draft red herring prospectus, is a publicly available document which contains essential details about the company who is planning an IPO. It is filed with the Securities and Exchange Board of India. A DRHP includes a detailed information about the company's finances, its promoters, the reasons for raising funds, and how the funds will be used, etc. If you want to access a company's DRHP, you can do it through various platforms such as the company's official website, stock exchange websites, or the official SEBI website. Now coming to the RHP, that is Red Herring Prospectus, it is an updated version of the DRHP post the SEBI approval. It includes the additional details such as IPO dates, prices, as well as up-to-date financial data. Sometimes, instead of launching an IPO or before launching an IPO, companies also go for private placement. So a private placement is a sale of unlisted shares and bonds to pre-selected investors and institutions rather than the general public. It is the method other than the IPO to raise capital. In this, investors are usually high net worth individuals, banks, and other financial institutions and insurance companies. Another term that a lot of people ask about is anchor investors. So anchor investors are institutional investors who are invited to subscribe a share of a company before the IPO. Yes, in that private placement I talked about earlier. In this, the investment is done within the declared price band and the anchor investor is supposed to buy the shares at a fixed price. Moreover, to participate in this issue, the anchor investor has to invest at least 10 crore rupees. Next is fair value. So it is the actual selling price of an asset agreed by both the buyer and the seller which benefits both the parties. It is calculated by analyzing profit margins, future growth rates, risk factors, and so on. In simpler terms, it is determined to ensure a fair value for the buyer without putting the seller at a disadvantage. Now, the next crucial thing is the pricing. So a company can launch its IPO by two methods, by fixed price or by book building. In the case of fixed price, the company sets a price right away. They do it by announcing the full price of the IPO beforehand. On the flip side, under the book building method, the company sets a price range and finalizes it by calculating the investor's demand. In this, the people interested in purchasing the shares are supposed to apply with the bid price and the number of shares they are interested in purchasing. Once the bidding procedure is completed, the company can determine the cutoff price, which is done by analyzing the applications received. The procedure is called book building. Well, as we are talking about the prices, let us also know about some more price related terms, which are the price band, floor price, and the cutoff price. So a price band is basically the lower price and the upper price per share with which the company will go public. Basically, it is the price range between which the stock gets listed. For example, if the price band is between Rs 150 and Rs 185, then the issue can be listed within the range. The next is floor price. When the issuer is convinced that they want to launch an book building IPO, they invite bids from the applicants for the shares. Here, the issuer is required to specify the minimum price and the maximum range at which it will accept the bids. The lowest price of this price range is the floor price. And lastly, the cutoff price. So the offer price according to which the shares are issued at the book building IPO is known as the cutoff price. Basically, it can be any price within the specified price band. If your bidding price is higher than the cutoff price, then the difference will be refunded to you. And on the other hand, if your bidding price is less than the cutoff price, you will not get the allotment and the amount will be refunded back to you. Also, you must know that you cannot apply for any random number of shares in an IPO. You will have to apply as per the lot size and the multiples of it. Let me explain. See, the IPOs have a minimum share that an applicant must apply for, which is the minimum order quantity or a bid lot. And if you want to bid for more shares, it has to be in the multiples of that lot size. For example, if an issuer offers a bid lot of 50 and in the multiples of 50 with a price range say Rs 100 or 150, that means you cannot apply for less than 50 shares in that IPO. Also, if you want to apply for more shares, then it has to be in the multiple of 50 like 100, 150, 200, etc. Next is lock-in period. So the lock-in period is that period of time during which the insiders such as companies' founders, owners, early investors and employees are forbidden from selling their shares. The purpose of an IPO lock-in period is to give the company time to stabilize after going public and avoid any mass sell-off that could drive the share price down. The next is oversubscribed and undersubscribed. See, if the company receives more applications than the offered shares, this issue is known to have been oversubscribed. Sometimes a lot of people want to buy shares more than what's available, then it is an oversubscribed situation. And on the other hand, if the issue receives fewer applications than the offered shares, the IPO issue is referred to have been undersubscribed. The next is green shoe option. When a company plans to issue shares, they use something called green shoe option. Basically, the green shoe option helps the company to sell more shares if there is high demand. This option works on over allotment of shares. Let me simplify this for you. So let's say if a company plans to issue 1 lakh shares, but it actually ends up issuing 1,15,000 shares. Now they will have to use the green shoe option. Here the extra 15,000 shares are borrowed, not new. These borrowed shares come from company's owners and promoters with a special agreement. See, for regular people like you and me, it doesn't really matter if the shares come from original 1 lakh or from those borrowed 15,000 shares. But for the company, it is very important. Moreover, the money earned from these shares are kept in a separate escrow account. The next up is OFS. So OFS or offer for sale is a method where promoters and public companies sell their shares and reduce their holdings through the bidding platform for the exchange. Basically, in this, existing shareholders get a chance to dilute their stakes via primary market. In simpler words, it is a transfer for ownership from one shareholder to another. Along with it, let me explain you about the market capitalization. So market capitalization or market cap is a simple metric based on stock price. It is a figure which you can use to analyze the value of a publicly traded company. To calculate a company's market cap, all you have to do is multiply the current price of share by the number of outstanding shares. For example, a company with 10,000 shares outstanding and stock price of Rs 500 per share would have a market cap of Rs 5 million. Last but not the least, Asba. So Asba stands for Application Supported by Blocked Amount, which is a method you can use to block your funds until the IPO you applied gets allotted to you. Under this, the respective amount gets debited from your account only if the shares are allotted to you, and in case you don't get the allotment, the amount gets unblocked. Well, these were some important IPO terminologies that you must know about. If you found the video informative, don't forget to share it with your friends and colleagues. And thanks for watching.